somewhere between $8,000 and $25,000. That is what a household earning $200,000 to $500,000 a year on a W-2 quietly overpays the federal government. Every year, not because your accountant made a mistake, not because you missed a deduction, because of something structural that almost nobody explains out loud. Picture the scene. Every April, you sign a tax return, you write a check, or you get a refund. Your accountant closes the folder. And nobody, at any point in that conversation, talks about the next 12 months. That is the entire problem. Here is the one question I want you to be able to answer by the end of this video. Is the person handling your taxes a historian or an architect? Because those are two completely different jobs. And almost nobody tells you that you hired one when you actually needed the other. Tonight, in 90 seconds, you will be able to tell which one you are paying for. It is late March. You get an email with a checklist. You upload your W-2, your mortgage interest statement, your brokerage summary, your childcare receipts. 2 weeks later, a return comes back. You sign it. You pay what it says, or you deposit the refund. You feel a small relief. Done for another year. Here is what just happened. In plain words, somebody took last year's numbers, put them in the correct boxes, and sent them to the government. That is it. That is the entire service. It is a reporting service. You needed someone in October to look at your projected income for the year, your bonus structure, the timeline of when your company stock actually becomes yours, your spouse's paycheck, your mortgage, your kids, and say, here are the 3 moves we need to make in the next 8 weeks before the window closes. That is a completely different service. That is planning. That looks forward. You hired a historian. You needed an architect. And in most cases, you did not know there were 2 different jobs. Let me introduce you to someone. Call him David. He is 42, works as a director at a mid-sized tech company, earns about $310,000 in base and bonus. His wife earns roughly $90,000. 2 kids, mortgage in a high-tax state. He uses the same accountant he has used for 11 years. Smart guy. Responsive, charges about $600 a return. David has never once had a phone call with him between May and February. David is not lazy. He is not uninformed. He reads the personal finance section. I will name it in about 90 seconds. Stay with me. Leak 1. Timing of income. When you get a large bonus. When your company stock becomes yours. When a spouse takes a new job mid-year, your actual tax bracket for that year changes. Federal payroll data shows that more than 60% of annual bonuses for households above $200,000 in income land in the 4th quarter. That is also exactly when the planning window is about to close. There are legitimate, in plain sight tools that shift income between years or reduce what shows up as taxable, but every one of them has a deadline. And most of those deadlines fall between October and December. If the first conversation about your taxes happens in March, every door has already closed. Leak 2. The type of accounts your money sits in. 2 households can earn the same income, save the same amount, and end up with a tax bill that differs by 5 figures, purely based on which buckets the money went into. Pre-tax, after-tax Roth account, taxable brokerage, health savings. Each one has different rules and different deadlines. A reporting service does not look at this. A planning service builds the entire year around it. Federal retirement data shows that W-2 earners above $200,000 hold roughly 70% of their long-term savings in a single account type. That is not a plan. That is a default. Leak 3. The things a W-2 earner cannot see from inside the W-2. When almost all your income runs through a single paycheck, it feels like there are no levers. That feeling is wrong. There are levers. They involve how you structure charitable giving, how you sequence sales of your company stock, how you pair a high-income year with a low-deduction year, how you coordinate your spouse's withholding with yours. None of this is exotic. None of this requires a shell company in the Caribbean. It requires someone who looks at your life twice a year instead of once. Let me say that again, because this is the sentence most people miss. It requires someone who looks at your life twice a year instead of once. Before I give this whole pattern its name, I want to show you the real dollar math. Behind that 8 to 25,000 number from the opening, that is coming in about 2 minutes, and it is the part you will want to write down. Now, you might be thinking, wait a minute, isn't my accountant already doing some of this? Fair question. Let me be honest about the counter-argument. Some accountants do offer planning. Some firms have a planning arm. If you have been with someone a long time and they are proactive, call you in the fall, ask about your bonus and your equity, run projections. You may already have what you need. Most do not. The fee structure does not support it. A $600 return cannot include 6 hours of strategy. The math does not work on their side, which is why it does not work on yours. The person preparing your return was trained to be accurate, on time, and compliant. They were not trained and are not paid to ask what your next 3 years look like. Those are two entirely different professions that happen to share an office. How much does that cost you at your income level? Rough math. A household earning $300,000 with typical deductions pays somewhere around $60,000 to $70,000 in combined federal and state tax, depending heavily on where you live. If you are in a state with no income tax, your number is lower. If you are in California, New York, or New Jersey, your number is meaningfully higher. A planning research group that tracks more than 2,000 high-income households found something. They found that roughly 10 to 15% of that annual bill is recoverable through forward planning. That is your $8,000 to $25,000 every year for 20 working years. Compound it at market rates, and you are looking at a second house. That is David's story. By the way, when he finally ran the numbers, the gap over 11 years came out to just under $190,000. Not from earning more, from keeping more. 20 years of quiet overpayment buys somebody a second house. Let that sit for a second. Quick gut check. If your household income is north of $200,000 and your accountant has not called you between May and December in the last 2 years, ask yourself honestly how confident you are that nothing was missed. That pattern has a name. People in the industry call it the reporting planning gap. For the rest of this video, let me just call it the gap. The gap is not a moral failure. It is a structural one. Knowing the name is not the point. What you do tonight is. There are 3 things, and the first one takes about 90 seconds. First, pull out your last tax return tonight. Not to read it, just to check one thing. Look at the signature block. Find the date your accountant first contacted you about that return. If the first contact was after January, you are paying for reporting, not planning. That is your answer. Second, before next October, ask one specific question of whoever handles your taxes. The question is this: can we schedule a projection meeting in the 4th quarter to look at this year before it closes? Listen to the answer. If the answer is yes, with a clear scope and a clear fee, you may already have the right person. If the answer is vague or the meeting never gets scheduled, you have your second answer. Third, understand what you are actually shopping for if you need to make a change. Third, understand what you are actually shopping for if you need to make a change. You are not shopping for a cheaper return. You are shopping for someone whose job is the 12 months ahead, not the 12 months behind. The title matters less than the calendar. Ask to see their planning calendar. If they do not have one, keep looking. This is how the math works. Your numbers are yours to run. The person who files your taxes is not the person who plans them. Once you see that sentence clearly, you cannot unsee it. And if the gap costs 5 figures a year on taxes alone, here is the uncomfortable follow-up. Your investment accounts are reported on every quarter. But who exactly is planning the order in which you will spend them in retirement? And what that sequence will cost you in tax?